Hello and welcome to Buy, Hold, Sell. My name is Camilla Cox. I'm a Senior Corporate Affairs Advisor here at Wilson Asset Management, and today I'm joined with some members of the Small and Mid Caps team, Cooper Rogers, Sam Koch and Shaun Weick. Let's get straight into it. Sam, Boral has a new CEO. Is this driving a turnaround?
Yeah, Boral's a buy. Boral's that well-known Australian construction materials provider that's been plagued with a lot of operational inefficiencies over the last couple of years. Their new CEO, Vic Bansal, we think is a great fit. He has the operational capability to deliver a turnaround plan. We believe the turnaround plan should really focus in on decentralising accountability, decision-making, focusing on revitalising the network and obviously realising the inherent value within the property. If you back out over $1 billion in property from the valuation, it's actually trading in line with the sector average. And we believe that there's a materially better outlook for this business versus its peers. The catalyst from here to see a re-rate is the Investor Day in May, and that should shine some light on Vic's new strategy.
Shaun, there's a lot of negativity in mainstream media surrounding the housing market, but can lifestyle communities deliver?
We think lifestyle communities can buck the trend. That's a buy for us. We think stabilisation in interest rates is within sight, and that will put a floor under housing market sentiment. The company has reiterated their FY23 settlements guidance, which implies a very strong second half and FY24 period, which is at the same time when the communities under release is more than doubling, which will drive a material acceleration in earnings growth from here. The valuation on the stock is screening attractive here at 17 times earnings with significantly above market earnings growth. So we like that one, it's a buy.
Continuing with the housing theme, Cooper, what do you think about Cedar properties?
Yeah, as Shaun mentioned, we think a stabilisation in rates will bode well for the housing market, but we have Cedar Woods as a hold at this current point in time. They kind of package land, develop it and then on-sell it and get that uplift from the retail buyer, I suppose. What we're seeing at the back end of the year though is some buyers kind of uncertain about the rates, not being as forward with the kind of initiations on interest levels for these new houses. And also we've heard of, kind of building delays that might push some of these projects into FY24 instead of FY23. So for that reason, it's a hold for now.
SKYCITY Entertainment, they were a beat, but there's been some regulatory uncertainty. So they a buy, hold or a sell for you?
Yeah, SkyCity for us as a whole, this is a really tough one because it actually fundamentally the business is improving, but the regulatory headwinds are actually keeping the share price back from outperforming. So it's a casino operator, as you alluded to, in New Zealand and Australia, much smaller exposure to Australia. And unfortunately, it's been painted with the same brush as Crown and Star here, although it has a better balance sheet. The regulatory environment in New Zealand is actually a lot less retaliatory and a lot smaller sort of exposure to the Australian business, about 15% of earnings. So a beat at the first half, a raise of full year guidance, the stock has underperformed. Our view is until regulatory uncertainty is cleared, the stock can't perform, so it's a hold.
Shaun, Dominos sliced at the result. Is it worth a bite yet?
We've chipped away and built a small position, but we think it's a hold. We just think there's too much uncertainty at the moment around the backdrop in Europe. I mean, with franchisee profitability under pressure, we think that is going to really have knock-on effects for the rollout in the future in that region. There's also a few question marks around Japan and sort of how inflated that's been on a post-COVID sort of basis. So we've got a hold on it at the moment, but yeah, I mean, valuation's staying to screen compelling for that business. So really just trying to look for a better entry point.
Cooper, with tourism recovering nicely, are you buying shares in Experience?
Yeah, Experience is one I've talked about before. It's obviously, as you mentioned, benefiting from the recovery of the international traveller. Also with that, we're seeing increased spend on experiences rather than goods, particularly from our Chinese and Indian travellers. We expect that to really bode well for Experience Co. The Skydive division is the one you want to look at. It's got massive operational leverage, and with those increased numbers coming back, a lot of that incremental revenue is going to drop through the bottom line. So yeah, EXP, buy for us.
Sam, buy, hold, sell, McMillan Shakespeare.
McMillan Shakespeare is a hold for us. We're really attracted to the industry leadership position that they've got in the innovative packaging space, but obviously the adjacent growth profile in the NDIS sector. The stock has gone for a bit of a run following the result. It was a solid result, and obviously distributions to shareholders were actually greater than expected. So we're looking for a better entry point to increase the weighting in the company.
Shaun, Ingenia Communities Group is another stock exposed to the housing theme. What are your thoughts there?
I've got a sell on this one. I think the recent result really highlighted the differences in operating model with its key peer lifestyle communities. I mean, underlying demand for land lease communities remains very strong, and that is reflected in Lifestyle's outlook. However, what's specifically impacting Ingenia is really around building and delays, in construction. Also, their position with the market's quite different. Their product's very different and pricing. So, yeah, we've got to sell on that one. It just looks too hard here.
Cooper, DDH, buy, hold or sell?
Yeah, DDH, it was a very soft first half they reported, and also along with that soft first half, they actually flagged weather impacts to their surface drilling component of their business. Luckily, the underground rigs utilisation was really high and kind of covered the surface in the first half. However, we still see the surface rigs a little bit soft so far in the second half. For that reason, this is a sell for us. It's also had a really tight labour market, so while those rigs have been not on the ground and actually drilling, they've had to keep on the labour component. So it's going to hurt margins, and yeah, unfortunately, a sell at this time.
Sam, what about KFC operator Restaurant Brands?
Yeah, great question. So KFC operator Restaurant Brands is a buy for us. If you've been to a KFC in New South Wales recently, you definitely would have been helping our holding. So effectively, they're a corporate franchisee that operates 370 stores around Australia, New Zealand, and the US, and they primarily focus on KFC. What we're really attracted to is the fact that whilst input cost inflation has impacted their business from a food standpoint and also labour and the availability of labour, we see that troughing and actually recovering from here, and you saw that in the last result. So that's what we're attracted to. I guess earnings upgrades and deploying excess capital are the catalysts that we're looking for to see a re-rate back to sort of the prior multiple that it's traded on to buy.
And Shaun, what about location tracking app Life 360?
I'm going to go out on a limb here and say this one's a buy. I mean, clearly sentiment's been impacted in the short term with, the broader US macro and I guess a capital raise as well that wasn't necessarily required in our view. But if you look at what's transpired, since they've issued, very strong calendar year 23 guidance, they've brought forward the point of profitability to the second quarter of this year. And that's often a key catalyst for technology stocks to drive a re-rating, particularly in this environment. So yeah, we think the stock's oversold and we like it.
Cooper, upgrades were hard to find in the recent reporting season, but was that the case for SRG Global?
Yeah, SRG was one of the rare companies that reported a really good first half. We're really backing management here, and they've consistently been able to upgrade guidance over the last couple of years. So, for example, in FY22 they indicated it was a 15% increase in EBITDA for FY22. And then this year they're expecting a 25% increase. Both times they upgraded at the half year result, which was again consistent this time. So we're expecting good things from SRG. They've already won $900 million worth of contracts this year, which compares to $600 million the year before. So that really underpins the organic growth of the business. And they've also acquired ALS's asset services arm. It's been an unloved business for quite some time, and we think the SRG management will be able to turn that around as well. So SRG, it's a buy for us.
Sam, IPD Group, buy, hold or sell?
Yeah, IPD Group, ticker IPG, is a buy for us. It's the Australian electrical wholesaling business where the founders still own over 25%. We're attracted to it because we believe it can outperform industry growth rates of 5 to 10% through exclusive supplier agreements, customer-centric business model, and exposure to growth areas like data centres. It's trading on about 14 times price to earnings ratio when you adjust for 10% of its market cap in cash, and it's got about an outlook for 15% earnings growth. We think the re-rate can come from deploying some of that excess capital into acquisitions and also earnings upgrades. It's a buy.
Shaun, private credit is a growing area in Australia. So what do you think about Qualitas?
Yeah, we think Qualitas is undiscovered, much like the private credit space. We think it's a buy. If you look at the most recent result, I mean, the underlying quality was very high. It's got 60% growth in its base business. The banks are continuing to retreat from the private credit space, which is underpinning very strong deployment opportunities. And globally, you're seeing institutional investors want access to what is a nascent asset class here in Australia. It's got positive leverage to rising rates. We think that one's a buy.
Cooper, surely a buy. Cooper Energy.
Yeah, gosh, it is a buy, but probably not for the right reasons at the moment. It had had a really poor half. Basically, it took over the Orbost gas plant from APA. They haven't actually transitioned the management, and as such, they were blaming APA for a low production performance. And so they actually had to downgrade production and downgrade the EBITDAX guidance at the half-year result. Management has since come out and said they've taken control of that plant again and expect the production to lift up. It dropped to 43 terajoules a day, and they think they've got it closer to 50, and hopefully that'll be consistent for the end of the year. For that reason, it's a buy on the recovery. But yeah, again, a very poor first half result.
Sam, Reece was a beat, but what do you think about their outlook?
Can I say I love a business? Reece is probably one of them, to be honest. Reece, although we've got it on a hold, given valuation and the macro, we're really attracted to what they've been able to demonstrate in Australia through industry-leading margins, industry-leading return profile for that type of cyclical business. And what we believe can transpire in the future is that they're going to take that model and replicate that in the US. We think that the US store network of about 200 stores can be multiples of its current size. Reece is a hold for us purely on the fact that it's trading on a lofty multiple, and also the macro is deteriorating sort of faster than we expect. But this is a business that we're happy back through the cycle hold.
Shaun, the government is increasing funding to the childcare sector. So do you think Embark Education and Cedar Education can benefit from that?
Yeah, I mean, we like the childcare space and we think they're a buy. If you look at the overarching macro drivers outside of obviously a significant uplift in funding from mid-year, unemployment's low and the supply dynamic is the most favourable it's been in probably 8 or 9 years. So starting on Embark Education specifically, they've divested their New Zealand assets and refocused here in Australia. The recent result highlighted a very strong trading update. From here, we think they're in a very strong position to deploy, effectively 30 million net cash into acquisitions. And we think they can exit this year at a 25 million plus EBITDA run rate, which implies the business is trading on a low to mid-single digit PE. So we like that one. And then on G8 Education, we think the management change that's there is a real catalyst to drive what we think is effectively an optimisation plan. And hopefully we start to see some news flow around that at the upcoming AGM.
Cooper, lastly, GUD Holdings.
Yeah, so the automotive kind of sector was a standout across kind of all of the performers in that area. So GUD is a seller of aftermarket parts for the automotive industry and performed really well. Its core business is becoming a lot more defensive, and that defensive nature underpinned a 9% EBIT growth throughout the first half. APG is the new acquisition that we're keeping a close eye on, though. We really want that to perform and want that to show its strength in the second half. It goes up, I suppose it performs well with four-wheel drives and SUVs when they come to the market. Luckily, we think the OEMs are kind of prioritising those vehicles. They're a little bit higher margins for the OEMs, so we think Australia will see more than their fair share of that type of vehicle. Hopefully this bodes well for APG. It's a hold for now, though.
That is all our stocks for today. So thank you to Cooper, Sam and Shaun.